Welcome back to Investing Talk Podcast.
Today we're looking at Robinhood Markets.
As usual, before we start, subscribe, like, and comment to this video to support the show. Now, Robinhood, ticker HOOD. Just saying the name, it triggers a fight in most investing circles.
Oh, absolutely.
Depending on who you ask, this is either the democratized future of finance right in our pockets, or it's a gamified casino that got lucky with a NASDAQ listing.
Right.
And looking at the recent action, the market seems just as confused. The stock is down significantly in the last few weeks. Volatility is through the roof. It really feels like a battleground.
It is a battleground, but I think if you stop watching the daily ticker tape and actually read the filings, the stories completely change.
How so?
This isn't the meme stock trading app of 2021 anymore. We are witnessing a metamorphosis into a legitimate financial powerhouse. The headline that should stop everyone in their tracks is the revenue growth.
Okay.
We are seeing 100% year-over-year growth.
Doubling the business in 12 months, that's a bold claim. It's exactly, doubling. And that changes the core question from, is this just a gambling app, to, is this growth sustainable, and is it worth the volatility in your portfolio?
Okay, doubling revenue is a great headline, I'll grant you that.
Yeah.
But we need to verify the quality of that revenue. I mean, anyone can sell dollar bills for 90 cents and double their revenue.
Sure.
When we look under the hood at the actual Q3 numbers, where is this growth actually coming from? Is it real, or is it just some accounting magic?
It's landing directly on the bottom line, which I think answers your quality question right there. In the third quarter, they generated $1.27 billion in revenue. That's the 100% jump I mentioned.
Okay.
But the net income is the real shocker. It surged 271% to $556 million.
Hold on. A 271% jump in profit. That outpaces the revenue growth by a massive margin. Usually expenses, they grow right alongside revenue.
Yeah.
That implies some serious operating leverage.
Massive leverage. And this is the key insight for anyone trying to value this company. Robinhood is proving it's a software company, not a bank.
What do you mean by that? Their expenses only rose 31% while revenue doubled. Because their infrastructure is code, not
physical branches.
Exactly. Not physical branches or expensive advisors. Every extra dollar of revenue flows almost purely to profit. They hit net margins of 52.19%.
52%. That is an absurd margin for a brokerage. I mean, for context, typical successful software companies, the Adobes, the Microsofts of the world, they aim for 30, maybe 40%.
Right.
Traditional banks are way lower because of overhead. 52% means for every dollar you give them, they keep 52 cents. But I have to play the skeptic here.
Of course.
Is this just from people day trading meme stocks? Because if the market crashes and retail traders get scared, does half that revenue just vanish overnight?
That's the classic bear case, but the data really refutes it. The driver isn't just transaction fees anymore. The biggest engine right now is what they call net interest revenue, which was up 66% year over year.
To margin loans.
Margin loans, yes, but also interest on uninvested cash in securities lending. They're acting much more like a lender than just a broker. Plus, they are monetizing their user base way better. Their ARPU average revenue per user jumped 82% to $191.
Wow, nearly $200 per user. That's crucial because it means they don't necessarily need to add millions of new users to grow. They just need to extract more value from the ones they have.
Exactly.
That feels a lot more sustainable than just chasing signups.
Precisely. They're cross-selling the gold subscription, the credit card, retirement accounts. It's a deepening of the relationship. They're building this whole ecosystem where you don't just trade, you bank, you save, you borrow.
Okay, so they've got the margins and the monetization, but they don't operate in a vacuum. You've got Charles Schwab, Fidelity, the old guard. I saw the Schwab CEO recently taking shots at Robinhood, basically implying their model is predatory or gambling. Is that a real threat? Can the big guys just crush them with a better reputation?
It's the classic incumbent defense mechanism. Look, Schwab says they are winning by rejecting the gambling model. But if you look at the engagement metrics, they are losing the war for attention.
Okay.
Robinhood has built what I'd call a competitive moat around user experience and network effects, especially with the younger generation. And they're innovating in areas Schwab won't even touch.
Like those prediction markets I keep hearing about.
Exactly. They rolled out contracts that let you bet on election outcomes, and now they're expanding that to economic indicators. It's controversial, sure.
Very.
But it drives incredibly high engagement. If you're checking the app to see the odds on the election or the next Fed rate cut, you might also buy some stock or check your crypto.
It turns the news cycle into a tradable asset. It keeps the app open. I can definitely see why that scares the traditional brokers.
And that creates high switching costs. Once you're used to that slick, all-in-one interface where you can trade crypto, stocks, and prediction markets, logging into a traditional brokerage feels like stepping back into 1995.
Let's look forward before we get into the stock price. We're sitting here on February 5th, and Q4 earnings are coming up, February 10th? What's the expectation?
The street is expecting the momentum to hold. Revenue projections are around $1.32 billion for the quarter. And for the full year of 2025, the consensus is that earnings per share, the EPS, will be up over 85%.
85%.
So fundamentally, the rocket ship is still fueling up.
Okay, the business sounds bulletproof, but the stock is not. If I bought Robinhood a month ago, I'm not feeling like a genius. I'm feeling poor.
That is the painful disconnect we need to talk about.
It's brutal. The stock is trading around $80.62. It's down about 22% recently. We've seen single-day drops of 8 or 9%.
Yeah, it's been rough.
I know the whole software sector is pulling back, but Robinhood is getting absolutely hammered.
It is, and I think context is really key here.
But look at the chart. It's sliced right through the 50-day moving average at $117. It's sliced through the 200-day at $120.
It did.
In technical analysis, the 200-day moving average is sort of the line in the sand. When you lose that, it's usually a signal that the long-term trend is broken. So, why isn't this a falling knife situation?
It looks ugly, I grant you that.
Yeah.
But you have to zoom out. Even at $80, we are trading way above the 12-month lows of roughly $30.
True.
What we're seeing now, from a technical perspective, is more of a basing process. The stock went vertical, it ran too hot, too fast, it needs to cool off, shake out the weak hands, and find a new floor.
So you see this as a sector rotation rather than a company-specific failure? Because to me, it looks like investors are just fleeing the scene.
I think it's largely sector rotation. Institutional money is rotating out of some of these high-flying AI and fintech names, just temporarily to reassess valuations. This 22% drop looks like capitulation.
Capitulation is usually that final puking moment where the last bull gives up and sells because they just can't take the pain anymore.
Which is often the bottom. We are seeing a dip buying setup here. Veterans in this space aren't selling here, they're nibbling. They see the 52% margins, they see the growth, and they see a stock on a 20% discount sale.
An opportunity.
They view this drop as an opportunity to accumulate shares from panicked retail investors.
Price is just psychology in the short term.
Yeah.
So let's talk about that psychology, the sentiment. What is the rumor mill saying? Because I'm hearing some wild things that sound almost too good to be true and, frankly, a bit conspiratorial.
The sentiment is fascinatingly mixed neutral right now because you have this bearish price action fighting against some massive, potentially game-changing rumors.
You're talking about the Trump accounts?
That is the big one. There are credible reports circulating that Robinhood is being considered for government-linked inflows or accounts associated with the new administration's initiatives.
Okay, let's break that down for a second. Are we talking about Robinhood becoming a trustee for something like a privatized Social Security account or some kind of sovereign wealth vehicle? Because that sounds massive.
That is the speculation. If Robinhood becomes the infrastructure for government savings programs, you aren't just onboarding retail traders anymore. You are onboarding millions of passive, sticky accounts.
The assets under management, AUM, would just explode overnight.
It would explode. And it moves them from being a retail app to being a systemically important institution.
That would be the ultimate legitimization. Schwab couldn't call them a casino if they're holding government pensions.
Not a chance.
That changes the entire multiple you would put on the stock.
Exactly. And the second rumor is just as potent for their specific demographic. SpaceX.
The IPO everyone has been waiting for.
We know SpaceX will eventually go public. The rumor is that Robinhood is positioning itself to be the key platform for retail access to that IPO.
Which is huge, because usually hot IPOs are reserved for Goldman Sachs clients with $10 million in the bank. The average Joe gets shut out until the stock starts trading on the open market, usually after it's already popped 50% or more.
Right. Retail usually buys the top.
Uh-huh.
If Robinhood can democratize the IPO process for the most hyped company on earth, it would be the biggest user acquisition event in their history.
Yeah.
It connects right back to that competitive moat we discussed.
Access.
Access to things you can't get anywhere else.
Those are incredibly bullish catalysts, but they're just rumors. What isn't a rumor is what the insiders are doing. And this is where I get worried.
The insider selling.
It's heavy. The CEO, Vlad Tenev, he sold 375,000 shares recently at around $121. Total insider selling was nearly $350 million last quarter.
Yeah.
If Vlad knows the government deal is coming or the SpaceX deal is coming, why is he cashing out a third of $1 billion? That screams top ticking to me.
That is the paradox. I mean, insider selling is always a red flag. It creates doubt. However, you have to weigh that against who is buying.
Okay.
While Vlad is selling, Kathy Wood and ARK Invest are buying the dip aggressively.
So one visionary selling to another, but selling into a rally is usually a sign they think the price is full.
It can be. But look at the institutional ownership, 93.27%.
That's high.
It is staggeringly high. It means the smart money, the pensions, the hedge funds, they basically own the entire float. They aren't scared by the insider sales. They're focused on the earnings power and the long-term compounding.
And they're just absorbing those sales.
They're absorbing those insider sales without blinking. And the analysts seem to be backing the institutions on this one.
What are they saying?
The consensus is a moderate buy, but the price targets tell the real story. The average target is around $136. Some are as high as $150. That implies the stock could nearly double from these levels.
That's a lot of upside. But my job is to protect the listener's downside. We need to talk about the risks. Let me play devil's advocate here. What breaks this thesis? Because at $80, it's not exactly a penny stock.
The biggest risk, without a doubt, is the valuation, even after the drop. It's not cheap by traditional metrics.
I was just looking at the price-to-sales ratio. It's trading at 23 times sales. For you, the listener, that means for every $1 of revenue Robinhood generates, you're paying $23 to own the stock. The 5-year average is only 7 times. That is a massive premium.
It is, and a 23x multiple demands perfection. If revenue growth slows from 100% to, say, 50%, which is still fantastic growth, the market will likely crush the stock because that multiple will contract.
And that's the growth trap. The company does well, but the stock drops 40% because investors decide it's only worth 15 times sales, not 23.
Exactly. Multiple contraction can be incredibly painful.
Yeah.
And we can't ignore the regulatory shadow. Prediction markets are dangerously close to sports betting. If the CFTC or the SEC decides to crack down hard, that high engagement revenue stream could just vanish.
Or if crypto enters another winter, a significant chunk of that transaction revenue is still tied to Bitcoin and Dogecoin volumes.
Correct. If crypto crashes, Robinhood bleeds. Their fate is still tied to the overall enthusiasm of the retail investor.
So we have a stock that has doubled its revenue, has software-level margins, and potentially massive government catalysts. But it's technically broken on the chart, the CEO is selling, and it's priced for perfection. How do we play this?
When I weigh the 100% growth and the 52% margins against those valuation risks, I'm giving this a bullish score of 8 out of 10.
An 8. That's pretty aggressive given the falling knife chart and the insider selling.
It is aggressive, but you rarely get a chance to buy a market leader growing at triple digits after a 22% pullback. The investment thesis is that this is the financial super app for the next generation. The margins prove the business model works. The rumors, they provide the optionality.
So is the play to try and catch the knife?
For a swing trader, yes. The setup leading into the February 10th earnings is a classic bounce play. The expectations are high, but the stock is oversold. A solid beat could send it back toward $100 very quickly.
And for the long-term investor, the person looking at a 5-year horizon?
You hold. You are holding for the catalysts. Think of the Trump accounts and the SpaceX IPO as free lottery tickets embedded in your shares. If they happen, this is a $200 stock. If they don't, you still own a company dominating its niche with incredible profitability. You're looking for multi-year compounding as they capture more of the younger generation's wealth.
So buy the fear, ignore the CEO selling, and hold for the revolution. It's a bold call, especially with the stock catching a falling knife right now, but the numbers, specifically that operating leverage, seem to back it up.
The numbers don't lie. The volatility is just the price of admission for this kind of growth.
That's the verdict on Robinhood. It's high risk, high reward, and definitely not boring. If you enjoyed this breakdown and want to stay ahead of the curve, make sure to subscribe, like, and comment to support the show. We'll catch you in the next one.